Nvidia just hit a wall that could cost investors billions. The company's next-generation Rubin GPUs are facing production delays because of a critical shortage in HBM4 memory. This isn't just a minor supply hiccup. This is a structural crack in the foundation of the entire AI infrastructure build-out. While retail money keeps piling into Nvidia on momentum, smart money has been quietly hedging this exact supply chain vulnerability for months. Here's what the institutions know that you don't. High bandwidth memory, or HBM, is the lifeblood of AI GPUs. Without it, even the most advanced chip architecture becomes worthless. Nvidia's Rubin platform was supposed to be the next leap in AI compute power, but it's now bottlenecked by HBM4 production constraints. Only 3 companies in the world manufacture this memory: SK Hynix, Samsung, and Micron. And right now, they can't keep up with demand. SK Hynix controls over 50% of the HBM market and is already maxed out supplying current generation chips. Samsung is struggling with yield issues on HBM3E, let alone HBM4. Micron is ramping production, but won't hit volume until late 2026. This creates a perfect storm where Nvidia's most critical component is in a supply stranglehold controlled by just a handful of players. Now let's cross-verify this with the macro data. First, global semiconductor capital expenditure hit $185 billion in 2025, but HBM production capacity only grew 22% year over year. That's a massive imbalance. Demand for AI accelerators is growing at 67% annually, while memory supply is growing at less than 1/3 that rate. Second, Nvidia's own research teams are reportedly unable to secure enough GPUs internally. When a company can't even supply its own R&D departments, that's a red flag for institutional risk managers. It signals that production allocation is being rationed, and external customers will feel the squeeze even harder. So how do you position around this crisis? 3 tickers become critical. First, VanEck Semiconductor ETF, ticker SMH. This gives you diversified exposure to the entire chip supply chain, not just Nvidia. When Nvidia stumbles on supply, other players in SMH like ASML and Applied Materials actually benefit from increased CapEx spending to solve the bottleneck. Second, iShares Semiconductor ETF, ticker SOX. SOX is more Nvidia heavy, so it's a tactical short or hedge vehicle if you believe the HBM4 delay will pressure Nvidia's earnings guidance. Third, Micron Technology, ticker MU. Micron is the only US-based HBM manufacturer and stands to gain massive pricing power as the memory shortage intensifies. Smart money has been accumulating MU since early 2026 for exactly this scenario. Now let's pull the historical lens. This situation mirrors the 2011 Thailand floods that wiped out 25% of global hard drive production. Back then, Western Digital and Seagate dominated the market. When supply collapsed, their stock prices initially spiked on pricing power expectations, but within 6 months, customers had diversified their supply chains and both stocks gave back all gains plus 30%. The lesson: short-term supply constraints create pricing power, but long-term they accelerate customer diversification. That's exactly what we're seeing now, with Amazon investing $20 billion into custom AI chips and Google partnering with Anthropic to use non-Nvidia silicon. Nvidia's monopoly is being challenged not because of better technology, but because customers refuse to be held hostage by a single-source supply chain. The institutions saw this coming. Hedge fund filings from Q4 2025 show a 34% reduction in Nvidia overweight positions among top macro funds. They didn't exit entirely, but they rotated into memory manufacturers and diversified chip plays. Retail investors, meanwhile, kept buying the dip, assuming Nvidia's dominance was permanent. Here's the tactical takeaway. If you're long Nvidia, you need to hedge with either SawXX puts or direct MU calls. If you're underweight tech, SMH gives you exposure to the CapEx boom without the single stock risk of Nvidia's supply chain. And if you're hunting for asymmetric upside, Micron is the play. The HBM4 shortage isn't going away in 2026. It's going to get worse before it gets better. And when supply is the constraint, the supplier holds all the cards. This is how smart money is positioning right now. The question is whether you'll follow the institutions or keep chasing momentum with the crowd. This analysis is for educational purposes only and does not constitute financial advice. All investments carry risk. Always consult a licensed financial professional before making any investment decisions.